credit. Today, most companies will give you the option of purchasing on credit. If you walk into Nordstrom, you will have the option of signing up for their credit card. What Nordstrom is offering you is a loan where you, as the debtor, are not required to pay for your things immediately, but you can repay it in the future. Credit can be in many forms: credit card, mortgages, auto loans, lines of credit, bank loans, leases. They generally can be categorized into two ways: revolving accounts and installment accounts. Revolving accounts, such as credit card or home equity line of credit, HELOC, means that you will be paying a different amount every month, and any amount that you pay is subject to a minimum monthly payment. An installment account is when you make a fixed payment that's due each month. Mortgages and student loans would classify as an installment account, and the total amount borrowed in an installment account is to be paid back over a set period of time. What is a credit score? A credit score is a 3-digit number that ranges from 300 to 850 in the United States. Your credit score is generally tied to your social security number and your personal information: your name, your date of birth, your address. Your score dictates your ability as an individual to obtain goods or services before payment is made, based on the trust between you as an individual and the creditor. The higher the score, the better the credit is. In the US, anything 500 or below and you will not be able to get a loan. A score between 620 and 680 will generally allow you to be approved for a mortgage. Depending on where your credit score is in the 600s, it will also impact the interest rate you have access to. So if you have a score in the high 600s, you may get access to a lower interest rate compared to a score in the low 600s. And then a score over 700 is considered good, and a score over 800 is considered perfect. So while the actual credit score range is very small, even a 50-point difference can greatly impact your ability to get a loan or the interest rate that you end up getting. A credit bureau is basically a company that collects information regarding your credit history. There are 3 main credit bureaus: Equifax, Experian, and TransUnion. Now, the federal law in the US allows you to get a free copy of your report from each of these 3 bureaus once a year. So if you go onto annualcreditreport.com, you can pull one credit report from each of these bureaus every 12 months for free. Each credit bureau will provide slightly different report containing factual information about your credit cards and your loans, when you opened your account, how much you owe, whether you make payments on time, if you miss payments, whether your debts have been transferred to a collection agency. Every report from each of these 3 bureaus will report on slightly different things. So what shows up on one report from TransUnion might not show up on the report from Equifax. So who can actually use and see your credit report? So credit bureaus follow rules that define who can see your credit report and how they can use it. So this could include banks and financial institutions, credit card companies, auto companies if you lease or finance a vehicle. Make sure you check out my video up top here where I talk about buying or leasing or financing a car if you're in that process. Retailers, insurance companies, government, some employees and landlords. Here are some things that will really kill or hurt your credit score: continually missing bills or being delinquent on bills, utilizing a majority of your credit limit, opening up a lot of credit cards in a very short amount of time, any filing of bankruptcy or foreclosures, which can stay on your credit report for 7 to 10 years. Now, credit bureaus will use scoring models to calculate your credit score. A scoring model can be seen as a formula. In the US, the most popular scoring model is FICO, used by at least 90% of lenders, particularly for mortgage approval, and it's generally the most recognized scoring model. So what is this FICO credit score actually made out of? Well, here you can see the breakdown. The most significant is payment history. This means paying bills on time. That's the most significant factor that impacts and affects your credit. According to FICO, past payment history is a predictor of how you will pay your future bills. And so credit scoring models, including FICO, will look at how late your payments were, how much was owed, and how recently and how often you missed payments. Generally speaking, installment loans, such as a mortgage, tend to be weighed more heavily than on a revolving loan. The next factor is credit utilization. Credit utilization is the amount of credit you're actually using divided by how much credit you are given. The golden rule of thumb is to not use more than 30% of your limit. So if you have a credit card with a limit of $10,000, you generally want to keep the balance below $3,000. It's okay if you do make a purchase over $3,000. What you want to do is pay off the credit card as soon as possible. So when your credit score is pulled, it will look at the amount owed at a point in time across all of your accounts. It will also look at how many accounts you have. The more credit accounts you have, this could be an indication of overextension. Now, these last three factors that I'm going to mention are not as significant as the first two, but can still make a difference when you consider them in aggregate. The first is the length of your credit history, which is how long your credit accounts have been in existence. People with high FICO scores generally have accounts open for over 10 years. Credit scoring models like FICO will look at how long your oldest and most recent accounts have been open. The longer, the better. Therefore, it's actually impossible for a person that's brand new to credit to have a perfect credit score. For example, a teenager who has never had a credit card before, or an adult that's moving to the USA would have to rebuild their credit in the States. Credit mix makes up 10% of your credit score. Credit mix signals to the lender how you've managed different types of accounts, whether it's a revolving account or an installment loan over a period of time. And they will consider the mix of credit cards, retail accounts, installment loans, mortgages, and the types of credit that you have. Lastly is new credit. So if an individual were to open several credit accounts in a short amount of time, that actually represents a greater risk and signals that this person might be in financial trouble. Here are some tips on improving your credit score. As I mentioned, credit utilization and payment history make up a significant percentage of your score. So you want to focus on those two things primarily if you're trying to make improvements. What you want to do is you want to first pull your credit score from annualcreditreport.com. Remember that it's free, and each of the three bureaus will give you one free credit report per year as per federal law in the US. You want to calculate your credit utilization ratio and try to get it no larger than 30% and pay down any credit cards based on this utilization score. So again, your credit utilization is how much you currently owe over your entire credit limit. To improve your credit score, you want to get caught up on missed bills. What you can do is set auto reminders on your phone when things are due, or you can set up notifications from your mobile banking app when things are due. Last tip is that you can actually apply for something called a secure credit card. A secure credit card is a card that requires you to put cash up front as collateral, and these cards are basically designed to help you improve your credit score. There tends to be some stigma around debts and credit, but having a good credit score and the ability to borrow money gives you options in life, especially when it comes to investing. Real estate investing in particular, but also any form of investing, where if the return on the investment is higher than the rate of debt that they're taking on, then it would be a favorable scenario. From a business perspective, many businesses are funded with loans, and they have something called a debt to equity ratio, which signals how that company is funded. A higher debt to equity ratio means that the company has chosen to take on more debt to grow rather than money from their shareholders. There tends to be a lot of conflicting information and views on debt in this world, and that is partially because everyone's risk tolerance is different. With higher risk also comes higher reward. A business can also write off the interest portion of any loans that they get for tax purposes. Speaking of real estate investing and growing your net worth, I think you're gonna love another video of mine, which is why net worth skyrockets after $100,000. So make sure you check out that video, which I'll leave up top here, and I'll see you guys in the next video. Until next time.